What is in store for 2022?
Yes, it's been a pretty decent year. I think last I saw the Nifty was up some 22% and NSE 500 was up 28%. Of course, we are up 52% for the year. So it's certainly been a great year for us. But it is going forward. I think next year is as we sit today. As you know, I never make Nifty projections. But it looks like a pretty decent year ahead if you look even in terms of the headline numbers as we sit today. I mean, given the news on virus and this and that, one never knows. But as I've said earlier on your channel also, that normally that, what's the apprehension that will there be a big crash? And normally the track record of any market usually is that big crash happens when you are very far above the trend line. So while we've had pretty decent 2 years, if you go back further, 2019 was not great, 2018 was actually a down year. And even if you look at the 10-year period from 2010 to 2020, you were up compounding only at about 8.5%, which was the fixed deposit rate at that point. So you had that room, you were very much below the trend line. You're still not at the trend line, let alone be very, very high. So that big risk is not there as far as the headline numbers for the markets are concerned. There are risks elsewhere, which is more to do with the macroeconomic front. I mean, I see risks on currency, inflation. Those risks are there for India and in different ways globally, at least on the inflation front. For the first time in a very, very long time, the developed markets have had to look at inflation. Otherwise, inflation was a background number for them. It of course, for the emerging markets, that is not the case. Or for India, that's not been the case. Inflation comes into focus very often. But where we are today, those would be the things where I would keep my eyes on the macro numbers. And of course, I mean, within India, even if you look at last year, I mean, this year, which is ending, sectorally itself, you will, let alone, I mean, in terms of stocks, the dispersion is very, very high. You look at the FMCG index, that's up 8% for the year. Nifty Bank, I think, is about 11% or so. Whereas you have a bunch of sectors like IT or metals and some other commodities and materials which are up 50, 60, even higher. I mean, I'm talking just the sectoral indices. So it depends how you did and how you will do more. So I think in 2022 will depend on where you are exactly in terms of sectors and companies.
So where should one be according to you? And if I have to take that trend line theory forward, I'm sure for IT and for metals, the trend line has to normalize towards the downside rather than on the upside.
See, IT in the middle of 2020, we made that call that if you remember, that was a time when FMCGs were greatly in favor. And if you look at it, this is not just only the trend line. You have to look at many things. I mean, my call was that you had this other sector like FMCG with reasonably predictable returns I mean, not returns which are as high as FMCG, but pretty decent and predictable in a very, very uncertain world. And yet the valuations were a fraction of what FMCGs were trading at. And that was a re-rating story. But now, of course, see, IT, one important thing I spoke about currency. So let me just, talk to you a little about that. I mean, this is just for the benefit of the viewers, I would like to say that in macroeconomic variables, when you look at from the government side or from a central bank, any policymaker side, what would you like to have? You would like to have high growth, you would like to have low unemployment, you would like to have low inflation, you would like to have low interest rates, you would like to have a strong currency. So you want you have all these objectives, but as all of us know, it is not possible to pursue all those objectives at the same time. So it's like trying to stuff 5 things into a box which can contain only 3 things. And when you stuff everything, something pops out from the other end. So what is happening now is that the RBI has decided to focus on growth because the economic growth, and especially below kind of the top tier is still hurting. I mean, if you look at even in terms of the citizens, in terms of whether they have jobs and what their incomes are, that below that upper tier, the situation is not so good. So you have a wholesale price index which is at a high of, I think, almost about 20 years or 15 years, and yet you have decided to hold on to the interest rates. It's not yet shown up in the consumer price index, but that happens with a lag. So you've decided to hold on to the interest rates, and people sitting in India think that we are holding on to the interest and the whole world is also not raised interest rates, because for us, the only two markets we look at are India and US, and Fed has not raised yet and India has not raised yet. But if you widen the horizon, you will, if you look at all emerging markets or the rest of the developing world, central banks have raised interest rates not just once, but twice, thrice, even 5 and 6 times. For from a Brazil to a Russia, you've seen rate hikes everywhere. So India actually is a outlier in the emerging market fact that you've decided not to raise interest rates. So you have high inflation, you've decided not to raise rates even though your peers have. So there's going to be strain on the currency. And the third factor is that if you look at the long-term chart of the rupee against the dollar, you either depreciate slowly, that 2 to 3% every year, or you have periods when for years it's in a band and then you have a sudden step down when the rupee depreciates. And we've been in this 73 to 75, 75 and a half band for a long time. So all these things point to a possible strain on the currency. I mean, this is all things are only in terms of probability, but I would say that this is a year where I would expect that there could be a rupee depreciation. So again, therefore, it is a good place to be in an export-oriented or an import substitution kind of sector. So IT services, and not just IT services, actually, there are non-service companies also within IT that we like. So IT as a sector, we continue to like for now. I mean, as I said, I never make a one-year projection, but metals, yes. I mean, while metals were, and for that matter, power and energy were great through the years. Through the year, and we have ridden that. But that story kind of started to taper off a little while ago. So I mean, right now I would say they're like more market perform kind of sectors rather than be very, very great. But this continues. You know, the IT continues. There are, as I said, selectively, you have to look at export or import substitution sectors, particularly in line of the PLI scheme. So you will have some pockets in chemicals, some pocket even in auto and auto components, not though, I mean, we don't like the two-wheelers, for instance, but there will be some pockets there. So you have to now be choosy as to who will benefit.
Interesting. Devina, given that, you've always advised against putting all your eggs in one basket and always mentioned that, limiting your investments to only one country is extremely risky. You guys at First Global are global investors. Besides India, on a relative basis, what are the other markets that are looking attractive at this juncture to you?
See, Aisha, this changes. I mean, I would like to put that caveat before I go into this, that this changes. So it is not a one-year view. But as we sit today, US and particularly some of the tech pockets still look relatively better than the rest of the world. And part of it is to do with currency also. China, which has been a dog and which we kind of cut back on very, very sharply very early in the year, around February or so, February, March. That now we have an eye on that, because I think that is one market where there may be changes. But of course, this year is going to be very much a place where you have to watch the macro variables. So that is one other thing which is difficult to predict. As I said, for the first time, for the central bankers like the Fed or the ECB, inflation is a factor. So what do they do? And inflation is, it is not like a one number. The thing with inflation is that you have inflation expectations, you have the central bank's view of the inflation. So it is like a kind of a nested loop. And as of now, the most likely outcome appears to be probably, 2 or 3 hikes by the Fed through the year. And then maybe towards the end of the year, that's what the markets are also pricing in, that they might have to backtrack because the impact on growth will be negative and markets would be negative. So they might even backtrack. So, I mean, we have to see how it plays out. And there are many uncertainties. If you look at inflation, for instance, in Europe, the power and energy inflation is off the charts. Some of the power costs in certain countries are up like 4 or 5 times for industries. So certain industries have become unviable. Aluminium, for instance, you have a power cost which is now more than the selling price of the aluminium. So that again will have a second order effect on metal prices. So this has been quite a news-driven year, 2 years. And that may continue with this additional thing of what the policymakers do in any of these markets. But as I said, as we sit today, these are the couple of markets that are looking interesting.
But Devina, whenever is that first sign of a rate hike which is going to come, even though the dot plot has given us many indication on when exactly it's going to be and how many at that. But will the market not meet that with a knee-jerk reaction? Because markets typically don't like money getting expensive.
Yes, I mean, that has been the reason why the Fed has been continuing with the loose money policy continued with that for a very long time, and the rate hikes have still not come. So, and particularly with the earlier idea of that, what happened the last time around in terms of the taper tantrum and all that. So that is there. But as I said, for the first time, inflation is becoming a factor. And as central banks, the thing is that, of course, for a time, inflation was classified as temporary and only because of supply constraint. And the difficult part, I mean, if I was a policymaker, would be that it is a fact that at least part of the inflation is from the supply side, whether it is all the bottlenecks in shipping and at the ports, or it is because of certain climate events in Brazil, which have increased agri-commodities prices. So that it is not all demand-driven inflation, though in the West there is a component of demand-driven inflation also, especially given all the government support that had gone to the citizens. So it is a difficult thing, because if you go into macroeconomic theory, the thing is that if you let inflation run, for whatever reason, the inflation expectations go up. And then that becomes a self-fulfilling kind of prophecy. And, the worst case kind of outcome is a stagflation. I mean, that's not my high probability outcome at all, but I'm saying that those are the things that the central banks would have to manage. And as I said, that expectation even as of today is that after the hikes, they might need to backtrack. I mean, so we'll have to see how this story unfolds.
So Devina, correct me if I'm wrong, but your message to our viewers and your clients is that you are in no hurry to reduce your allocation to equity as an asset class, within that you may churn from one sector to the another sector, but the allocation towards equity as an asset class in the portfolios you manage is not going to change significantly for 2022.
Not as we sit today. I mean, and part of the reason, Nikunj, I'll tell you, is that the uncertainty on fixed income is probably even higher. So that is part of the reason why, that's not, at least fixed income as a class is, we might look at some other smaller asset classes, but fixed income as an asset class, again, has a great deal of uncertainty. In fact, through 2021, I found that in our global fixed income portfolios, we had to manage it far more actively than we had to manage the equity side. And I mean, we've done extremely well for the year. That aside, and on the fixed income side, but this was that as a strategy, we had to kind of relook at it every month and a half, and make many changes along the way. So that and as we sit today, I mean, all the uncertainties we are talking about are magnified for fixed income, because if when you're talking of macro and you're talking of policy, that impact on fixed income is even more direct than what it is for equities.
Do you see flows reversing back into India? Because that's been the irritant. While DIs have been buying, thanks to PMS like yours and HNI activity, we're getting a cushion in the market, and markets are able to absorb the 70-80,000 crore of FI selling which has come. But the FI selling still continues. It started in October, it's December end, and there has been some consistency. Into 2022, do you see allocation changing?
Nikunj, I think I've said it earlier on your channel also. I don't think how much money comes in from FIIs is any big indicator of where the market is going, because we are really looking at it as a kind of what impact will it have on the market. And if you look at long-term statistics, right from the time FIIs started coming in, right from 1993, so if the money came in, started coming then, and if you see the history of the Indian capital markets, the 1994 to I think 2003 or 2002, something like that, that 9-year period was about the worst performing patch you had, where the markets went nowhere in spite of this new source of money coming in and all that money pouring in. So the market move actually happened before the FII money came. And even on a month-to-month basis, even before, we had so much of a mutual fund industry or a domestic institutional industry. But even prior to that, there is little correlation with how much money comes in. And let me also, I mean, we talked about global allocation and which markets look good. So India definitely is still in the outperformer list as far as, our outlook goes. So I missed out on that. So, I mean, that depends on a lot of other factors about what is happening with how much is the emerging market allocation and what's happening there. But as I said, that if you're looking at it as a viewer to give you an indication of what will happen to the markets, I don't think that's a very relevant statistic.
Closing thoughts. Now, we've seen this excitement in the PE space getting challenged. Some of the companies which got commanded crazy multiples in the private space are getting challenged when they're going public. And that has happened largely in the fintech space. How do you see that space evolving?
So you're talking about the new listings, or you're talking about that like new listings in the pipeline? You're talking about the stocks that are already being traded?
Yeah, everything. I mean, it was more like a passing the parcel, which was happening in the private space, where one P investor would come, the second would come on higher, and the third one would come at higher. And everyone thought that will translate into even greater listing for some of the fintech or insurance or the new listings, but that has not happened. A lot of listings are below the offer price, and irrespective of who the backing is, the stocks have not really created a lot of wealth, at least in the month of November and December, with the exception of, let's say, Nika.
Yeah, actually, see, it is not just also the valuation at which the PEs came. It is or the VCs came. I mean, this is really you have made those offerings at a multiple of even the last fundraise, even if the last fundraise was just 3 months, 2 months, or 6 months ago. So that is the thing. So, and many of them, a large chunk has been an offer for sale rather than a new listing. So it has really been an exit not a full exit, but obviously a meaningful exit for the earlier investors, whether it is promoters or financial investors. And that whole thing got overdone. I've spoken about it the last time I was here, that as a investor, you have to be very, very cautious, because what happens is that once there is this kind of IPOs coming in, people stop looking at the companies as companies or valuing them the way you would value a already listed company. It sort of becomes that this is some other path where you have to value things on a different way, or that you don't have to value it at all. If there is enough interest, you just try getting this lottery ticket. So that is that always happens. And whenever there's the IPO sort of floodgates open, pretty soon you get all kinds of companies coming there. So my advice to the viewers will be to be very, very careful, and more so, see, many of these companies with no earnings, and this I'm not talking just India, but wherever in the US or elsewhere, that was a big thing when interest rates were very low in the US, when you or in Europe where interest rates were negative. So in that case, you are okay with something which is not making money, which is going to make money hopefully 10 years hence, because the discount rate is so low. That cash flow even 10 years out are pretty valuable. If the interest rates rise, that anyway, that the discount rate rises and that cash flow is no longer as valuable. But even so, if you look at most listings, and this is not fintech, but any of these so-called new age no profit IPOs in the US, those also didn't do well. If you look at the ones that have been listed 2-3 years from Uber onwards, and you will see that they haven't done particularly well. And of course, in India also, it is not just the financial, but whatever IPOs, if it's an overhyped IPO, overpriced IPO, it will not do well at the end of it. Most of the time, that is the case. So you have to be very careful, and particularly in the case of financials, of course, many of them are not really the lending businesses. Many are platform businesses which are burning money to get customers, which is a different model. But if when you get the lenders also, then there's a whole different kind of risk that comes along with that. But that's another matter. But right now you had mostly companies which are calling themselves tech companies, but which are really either platform companies or D2C companies, selling directly to customer companies. So there you have to use normal valuation. You can't
Right.
just say this. Yeah.
Right. Devina, we're getting all serious here. It's almost the year end. I know you're a voracious reader, so why not list out your top 5 reads for the year ahead for our viewers?
I'm planning to write for ET Maya. So off the top of my head, that Ed Thorpe book, The Man Who Solved the Markets, I think that is the name. That is one. Then book I'm reading just now, The Body Keeps the Score. I mean, this is not a financial book, but it's a very interesting book on how trauma affects your mind, body, and brain, how it actually changes it. There is Psychology of Money, which most of your viewers may well have read, and particularly I would recommend it to the young people and people who are starting out new in the markets, because it gives you a framework of how to think about money. I don't agree with 100% of what is said there, but it certainly gives you a framework. If for next year, it is not just what I've read last year, but I always recommend that do read about how your mind works in terms of your biases and so on. And so we had Thinking Fast and Slow from Daniel Kahneman. His new book, Noise, came out this year. So both of these I would recommend. And I would also recommend that you read The Halo Effect if you haven't read it, and Richard Thaler books on behavioral finance. So there are a whole bunch of books that are out there that you can read. As I said, I plan to do a piece for ET on the roundup for this year.